All right, what's going on, tax professionals? Andy Fry here at Pronto Tax School, and in this training video, want to talk about some landlord tax issues. So if you have landlords for clients, this is going to be a very relevant training video for you. And specifically, we're going to focus in this video on some of the painful situations that landlords are going through in 2020, and also some of the opportunities that are available specifically with regard to these 2020 tax returns. So as we go through and we start prepping these 2020 returns, this is kind of a preview of what we should expect and some things to help our clients avoid as well as potential opportunities. So just a good place to start is just say that 2020 has just been really rough on a lot of landlords. It's been rough on renters, right? 31%, according to the New York Times, of all renters didn't pay rent in April of 2020, and it's probably going to be tough, throughout the rest of 2020. So obviously, that's going to impact landlords quite a bit in decreased income, rental property losses, and everything, and also just stress, right? Being responsible for potentially evicting some people that can't pay rent, families, people that are really struggling. It's very difficult on someone's psyche a lot of times. And so we can't underestimate that as well in terms of that responsibility, and just being involved in that kind of situation is just not easy for anybody. And so as we go into the 2020 tax returns that we're going to be preparing for our landlord clients, we want to keep these struggles in mind. And we also want to just realize that they just need help. And like anything with the tax business, right, every problem is an opportunity for us as tax professionals, and we're going to see a lot of dissatisfaction with the current solution for landlord clients. So whether that's a tax professional that maybe isn't fully up to speed on landlord tax issues, or landlords doing their own taxes on TurboTax or DIYing it online and not satisfied with the results that they get. So you can have a lot of shopping around among landlord clients. And that's going to, just the nature of these issues going to create a delta or a difference between what other solutions can provide to these clients, both in terms of hard dollar savings and also reducing the client stress. So there's going to be a strong difference in a lot of cases between what you can do when you're fully up to speed on these issues and confident on these issues versus what another solution can offer. And so that's a huge opportunity for you as a tax professional. And keeping in mind that a lot of times these landlords are high fee clients. A lot of times they have multiple properties. A lot of times they're self-employed, or they're a high income earning W-2 with a lot of investments, a lot of things going on. So a lot of times these type of tax returns, can be $1,000, $3,000 type of fee, and a loyal client over time. So it's just a high value area for tax professionals. It's an opportunity where if you really give a great service to this type of client, it's not commoditized. It's not just a price-based decision in most cases as to whether this client will work with you or choose another solution. So there's really an opportunity to develop that loyalty and kind of stickiness between you and the client. And there's also a lot of need for related services. So if you are, as a tax professional, also offering, financial advising services, if you're involved with real estate, if you do paralegal work, right? Like these type of clients, they have a lot of different needs, and so if you're offering other services, this is definitely a rich client group in that way. And also, it's just pretty fun type of work when you get the hang of it. As far as real estate taxes, just amazing how many tax breaks that you can access in this area. And when you feel that confidence, it's actually pretty fun to work with these clients. So this video is just going to kind of bring up some of the issues we will for sure see on 2020 tax returns. And again, with that goal of increasing our confidence as we work with this client. So one thing that we're going to see, right, with tenants not paying rent, or missing months of rent, trying to make up past rent, and everything we just talked about, right, that's been so common in 2020 with all the economic challenges, right, especially job losses for renters. We're going to see a lot of losses, right? So here's an example of a loss on a Schedule E. So, expenses from the rental property exceed the income, so we have a loss, right? And then we jump over to Schedule 1, and we see that, hey, that loss is not showing up, right? It's not showing up on the Schedule 1. And what happened to it? Okay, it's not showing up as a negative against the client's $250,000 worth of W-2 income, right? So we're looking for that negative to get some credit for that loss. And most importantly, the client is looking for that, right? Like, hey, I know I took a bath on this property or on my rental properties in 2020. I want to see some kind of tax benefit coming in against my W-2 income. And then in this case, we're not going to see that, right? So if you've dealt with this before, you know that it's going to be an issue of the passive activity loss limitations, Form 8582. And there's the loss there, and you can see as you move down the form that because of the modified adjusted gross income of the taxpayer, of the client, that loss is being reduced to zero in terms of being able to actually claim that loss against other income, against ordinary income. So the loss is being totally disallowed. Now, whenever we have that situation where we see a loss, right, and then it's not showing up on the tax return, and we know that a loss would decrease the tax of the client, I'm sure you've had this experience, right? Maybe the first few times you encountered this, where you start checking some boxes, right, on the Schedule E, and you kind of are trying to see how you can get that loss to be allowed. And so here's a few of the boxes here that you could possibly check that would change the ability for the client to receive some benefit from that loss. And so the real estate professional box, you're going to notice when you check that box, that is going to allow a real estate loss on Schedule E just as if it would be ordinary income, right? Just as if it was like a Schedule C loss, for example, and it's going to be a minus sign against that W-2 income, in which case it's going to be a significant reduction of tax and can be very tempting to check that box. And so it's tempting in both a good way, right? So you're looking for benefits for the client, but it's also very dangerous because this is actually one of the more audited areas for the IRS is if you claim a real estate professional loss on Schedule E without actually meeting the tests. And so the tests are really not that complicated, and just understanding when it's okay to check this box and when it's not. And there's two main tests that are described in Internal Revenue Code section 469. So I put the link there for you in case you want to read it directly from the IRS code. And the two tests are to spend more than 50% of your time, your total working time, on real estate activities, okay? And that can actually be spread across multiple properties. So again, a lot of times these real estate clients, right, they may have 2, 3, 4, 5, 6 rental properties. So more than 50% of the time, and again, it can be on multiple properties, doesn't have to be just on one property, but more than 50% of your time, if the client has a full-time job already, that's probably not going to qualify. And that's something that's often disallowed in these audits from the IRS. If they see, hey, you have a W-2 job, you're a doctor, you're an attorney, we know that you're spending more than 50% of your time on your regular job, right? Not more than 50% of the time on real estate activities. So that's going to be very tough to meet that test if the client has a W-2 job, has a day job, right? In addition to that, it has to be at least 750 hours of involvement with real estate activities. And again, that can be spread across multiple properties, right? But that's the second test for as whether you actually are a real estate professional. Now, notice there's not a requirement to have a real estate license, right? A lot of people think there is a requirement to have a real estate license. That's actually helpful, right? If you're involved with an audit on this issue, it's helpful to show that the taxpayer, the client, actually is a real estate professional. But these are the real tests of whether it's okay to check this box or it's not. Now, one of the kind of little tricks of the trade in working with these kind of clients is that if one spouse does have a W-2 job, let's say, for example, it's a doctor, and the other spouse does not have a W-2 job, a lot of times that other spouse can become or be classified as a real estate professional in order to sort of unlock the ability to check this real estate professional box for the other spouse that's managing the properties, maybe helping to, rehab the properties, fix up the properties, collect the rents, all that kind of thing. So if it's a married couple, that's one kind of loophole, you could say, right, that can unlock some of these losses on a tax return. Now, another key thing for real estate clients here in 2020 especially is going to be clients that are looking at selling their real estate properties, right? Um, there's a lot of kind of like moving pieces with the real estate market. The market's been up a lot over the past 10 years, right? If you remember back to the financial crisis of 2008 to around 2012, property values were way down, right? And then they've gone way up. And so when you combine that with, not being able to collect your rent in a without a bunch of hassle, right? Without feeling like, oh, I gotta, you know, threaten these people with eviction, and the people are already out of work, right? They're struggling, they have a family. I don't want to kick people out on the street, and all these kinds of, struggles that these landlords are going through. Um, and meanwhile, the landlords are having to pay their mortgages, their real estate taxes, right? They haven't gotten a whole lot of relief as of yet, but they have gotten hit on the rents. And so just overall, right, you're going to have a lot of clients that are dealing with rental real estate that are saying, hey, maybe this is a time for me to look at selling. And so whenever a client looks at selling, what comes up, right, is the taxes, right? The income taxes that I have to pay, the capital gains taxes that I have to pay if I sell. And so one thing we want to keep an eye out is which are the clients that maybe have been having their losses disallowed for multiple years, right? And so they may have a banked up or saved up Form 8582 loss. And you can see here in this case, this would be like $66,000. And so this is a suspended passive activity loss, right? So when the property comes to be sold, this loss is going to be able to be picked up and is going to decrease the gain on the property. So it's going to kind of unlock some benefits from past years, and can significantly change the amount of tax that the taxpayer would, that the client would pay, right? So taking a look at this, and again, a lot of times these clients will have multiple properties, and so certain property they might be having like a lot of problems with, maybe it has a lot of repairs, maybe it's got very challenging tenants. And so taking into account any unallowed losses from prior years and seeing, how much would this decrease the net income from this property, the net gain, and how much would that decrease the tax cost of kind of getting offloading this property, you could say. So that's another major consideration that we'll see. And so another thing that we got to keep in mind with these passive activity loss limitations on Form 8582, which is very common for a higher income owner of rental real estate, is that passive activity losses can go against or decrease passive activity income, right? So one of the things that rental real estate clients can look at if they have, or if they're getting limited by the passive activity limitations, is generating more passive activity income. And so an example of this will be something like Yield Street. This is a type of investment fund that generates some passive income that can kind of eat up the loss, right? That's not being allowed, to essentially create tax-free income. And of course, as tax professionals, unless we're a licensed investment professional, we don't want to get into, recommending one investment or not, but just being aware from a tax point of view, right, that if you have a passive activity loss that's being disallowed, the opportunity to generate passive activity income without actually having to pay tax on that income can be very appealing, right? Because you already have the loss there, and it's going to go ahead and eat up and erase any passive activity income that you generate. And so again, the clients that are in this situation, a lot of times they do have some money, right? They do have some investments. And so if we can kind of match up those investments to generate some more passive income, and with the passive activity losses from the rentals to eat that up and eliminate the tax essentially, that can be a very worthwhile conversation to have with a client, and something to definitely keep in mind. Now, another conversation that can be worth having is, especially as you have, kind of a lot of baby boomer clients, right? Or clients that have built up significant real estate portfolios over time, highly appreciated properties, relative to when they first bought them. probably like claimed a lot of depreciation, so the basis of the property is very low, is a lot of times the 1031 exchange is kind of the, the best move for that client, right? To do a tax-free trade into another property. But some of these clients, they may be sick of dealing with the actual management of the property, right? So they don't want to pay the taxes on the gain. They know they have a large gain because they bought it for, very low relative to what it's worth now, and they claimed all that depreciation. So there are a couple different options for trading and getting on 1031 exchange, trading on a tax deferred basis into a new property, but not actually having to manage that property. And so a couple options there would be something like a tenants in common, where you're buying, say, a building um, that's going to be managed by another party, and you're kind of participating as a partner, right? Or you're getting a K1, you're getting passive income. Another option would be one of these Delaware statutory trusts. So I cut and pasted a source there if you want to look into this a little bit further. Essentially, the strategy here is to, avoid having to pay tax on the gains of those properties, while also offloading the management responsibility. So just wanting to end being a landlord, right? And having to deal with the tenants, having to deal with the repairs and everything that goes along with it, but still avoid paying the taxes on the gain of the property. And so these are a couple other things that some of the more savvy clients will be looking into, right? And certainly worth, worth you knowing about and feeling confident with as you deal with these clients. Another thing that's a bit underrated, I think, is a seller carryback mortgage, right? So this is from the website Money Under 30. It's kind of aimed at younger taxpayers, or I should say younger clients that want to be able to purchase a property without a traditional mortgage. So depending how mortgage qualifying happens or what the job market's like, right? This is an opportunity to essentially get a mortgage from the seller of the property. And for your client that may be a landlord, this may be a way to, say, sell the property to the existing tenants, maybe, or just overall increase the amount of income you see from the property sale. And you can see this is from bankrate.com, the amortization schedule. So let's say it's a $500,000 mortgage. The total interest paid is going to be over $400,000 over the course of 30 years, right? So as if the seller is actually the one making that mortgage, is the one lending the money essentially and carrying the note on the property, that's a considerable increase in the amount of income that's actually coming to that seller, over $900,000 versus $500,000, right? And so again, this is something that we don't want to get into necessarily advising clients to do this, because there are some thorny situations that can come about with this, right? Especially if it's not done correctly. But just overall, this is an option that this type of client may want to consider as they look at their options. And so in addition to getting more income out of the property by carrying back a seller mortgage, there is a beneficial tax treatment in terms of you're essentially reporting the sale as an installment sale, and that's spreading out the capital gain over the years that the mortgage is being paid back. So again, this is a source of a nice article from Jonathan Goodman that kind of talks through the particulars of how that would work. And you can look at the date on the article, and you can see, again, this is right around that financial crisis time. So now, you're seeing a lot of similarities to that time frame, right, with real estate. And so these clients that are looking at that time, right, and saying, hey, what are the other kind of unconventional options that I may have available as I'm looking at my options with regard to real estate. And so this is something that, by spreading out the gain, right, over 30 years and taking a smaller amount, especially if that client is going into retirement, right, or they're not going to have as much income in the future as they do now, and therefore their tax rate may be lower, then this can be something that can be kind of an added benefit to decrease the taxes from a property sale. Now, this is another one that's a really good website. I don't think I pronounced this guy's name correctly, but he's a really awesome writer, and about financial and tax topics. It's kitsees.com. And this was a nice article that he had, which is talks about another kind of idea that some landlords might look at, which is to move into. So say a landlord will sell their current primary residence to get a tax-free gain, and then move into the rental. Okay, and try to then go and use the 2-year use test, right, as a primary residence to exclude the gain on the sale of the rental. And this would be something that's like kind of on the creative side, right? And so this is a good article. I just put a link there for you about a couple of the catches that the IRS has put into that to kind of mitigate taxpayers, kind of you could say taking advantage of that, right? So just kind of summary is that it's not as simple as it may seem. It still can be a good idea, but you got to look really at the particular things that Congress and IRS has put in to kind of mitigate the gain elimination and by this strategy. So definitely worth a look as well as you're dealing with these landlord clients. And as you can see from all these considerations, it's really that conversation, right, with a landlord client about risk versus reward. And it's something that the clients are familiar with already, right? They're already in that zone of, they made this investment, they took on this mortgage, they're trying to see if the pet tenant's going to pay rent this month or not, right? What are the consequences if the tenant doesn't pay rent? All of that risk reward calculation is something that the client is very familiar with, by having a rental property or multiple rental properties. And so you just, being able to talk about that and in that framework with regard to taxes is quite valuable to clients. And that's what I meant by, it's not an experience that clients can get just anywhere, right? It's kind of a higher level experience that you're giving that client, and you're kind of getting on their level of talking about risk and reward, specifically with regard to tax issues. And you're also looking at cost versus benefits. So that's one of the main challenges with these type of clients is being able to separate out, right? Like if you're doing projections as far as a 1031 exchange, if you're looking at tax planning opportunities, all that kind of stuff that's forward looking, right? Or that's outside of really the scope of tax preparation. So you have your preparation of the 2020 tax return, right? But then you also have things like, well, what if you're going back and amending past tax returns to claim a net operating loss? What if you are developing a plan for how to dispose of this property at the lowest tax possible? Those are kind of separate services, right? So those should be looked at and kind of delineated to the client as to what's included in your 2020 tax preparation in terms of the fee, right? The fee for the tax professional versus what is a different service and what's the price of that service and what's the benefit of that service that the client should expect. So just being able to get on that level with these clients is a huge, is hugely important, because otherwise what can happen, right, is we as tax professionals can end up studying up on all these things, right? And having these great conversations and saving people all these tens of thousands of dollars. And then if the client doesn't have an expectation, hey, this is going to, there's a cost attached to this service, this professional service that I'm getting, then that's when, there can be some issues between you and your client, right? Where you don't feel like maybe you're getting, rewarded yourself as you should be. And so thinking through those things and just, how you handle your pricing, how you handle your client communications, super important with this type of client, especially when they have big decisions that they're thinking about making, which I definitely expect during the preparation of these 2020 returns, with some of the losses, with the challenges that the landlords have been going through. People are going to be looking at making changes, and so this is a very high value service potentially in terms of, helping the client reduce their pain, right, and increase their gain from your service and from your knowledge. And then at the end of the day, certainly with these type of clients, extremely important to have them take responsibility for their own decisions and really own their own decisions. So we are here as a resource. We're here as somebody walking along this path with the client, and certainly want to show them different options that they didn't know about, present different ideas, run numbers about different scenarios, and also let it be known to the client, repeatedly, consistently, that it really is their call. And that's where a lot of the liability can come in with this type of tax work, is if the client is having an incorrect perception, right, that you are recommending something, when in reality, what's appropriate for us to do is to present options and be able to talk through things with clients. And then clients really need to be able to make those decisions for themselves, and they need to take ownership of those decisions. And most of these clients, they're used to making decisions, right? They made the decision to buy a rental property or buy 3 rental properties. So they're already kind of in that headspace. But as a tax professional, it's just so important as we talk through these options, especially the more creative options, right? Like doing a seller carryback mortgage, for instance. The last thing we would want to do is appear to recommend that, right? And then next thing the person's not paying back their mortgage, and the landlord has to go foreclose. And they look back at us and say, "Hey, you said to do this," right? So it's just a communication challenge, and something that in this new era of tax, right, we are getting better and better at communicating with clients, in these more proactive ways to protect both the client and ourselves. And so that's something that's just really important to kind of consider as we look at these different options. And yeah, hopefully that's helpful for you. Definitely going to see a huge need on 2020 tax returns from landlords, and a lot of things on their mind, a lot of conversations going through that type of client's head. And if we can be a resource for that client, it's going to be great for us, and it's going to be great for the client. So let's do it.